Hello finance fans! In today's video, we will look at 7 common mistakes investors make, which ends up costing them serious money. We will also discuss ways to prevent these mistakes. My name is Charles. I'm a CFA charter holder with over 15 years of experience in investment banking and financial planning. The first mistake is thinking short term. Making investment decisions based on immediate market fluctuations or news headlines rather than looking at the long-term fundamentals of an investment is a common mistake many investors make. This mistake can lead to impulsive decisions that may not align with your long-term financial goals. By focusing on short-term gains or losses, investors may miss out on the potential benefits of holding on to an investment for a longer period, such as compounding returns and growth over time. It is important to have a balanced approach to investing. Consider both short-term and long-term factors to make informed decisions. Warren Buffett has said, "The stock market is a device to transfer money from the impatient to the patient. Think long-term and you will be rewarded." Trying to time the market is a common mistake where investors attempt to predict the best time to buy or sell investments based on market trends or economic conditions. This strategy relies on making quick decisions to capitalize on short-term fluctuations, which can be unpredictable. Investors who try to time the market often end up buying high or selling low, missing out on potential returns or incurring losses. It is challenging to consistently predict market movements, and this approach can lead to emotional decision-making. Instead of trying to time the market, it is generally recommended to focus on a diversified investment strategy and stay invested for the long term to weather market fluctuations. Following the herd in investing refers to the tendency of investors to make decisions based on the actions of the majority or popular trends in the market, rather than conducting their own research and analysis. This mistake can lead to herding behavior, where investors buy or sell assets simply because others are doing so, without fully understanding the potential risks or benefits. When investors follow the herd, they may end up buying assets that are already overvalued or sell investments that have strong long-term potential. It is important for investors to think independently, do their own research, and make decisions based on their own financial goals and risk tolerance, rather than blindly following the crowd. Confirmation bias in investing refers to the tendency of investors to seek out information or opinions that align with their existing beliefs, while ignoring or dismissing information that contradicts them. This cognitive bias can lead to making decisions based on incomplete or biased information. When investors succumb to confirmation bias, they may only pay attention to news or analysis that supports their investment thesis, leading to a lack of diversification in their portfolio and potentially missing out on valuable insights that could challenge their perspectives. This can result in poor decision-making and increased risk in their investments. To avoid falling victim to confirmation bias, investors should actively seek out diverse sources of information, consider different viewpoints, and regularly review their investments to ensure they are making informed decisions. Being open-minded and willing to challenge our own assumptions can help us make more objective and rational investment choices. Not investing is a huge mistake some people make out of fear, indecision, or a lack of confidence. This bias could include a fear of losing money, a reluctance to take on risk, or a belief that investing is too complicated or time-consuming. Individuals may miss out on the potential benefits of growing their wealth over time through strategic investment decisions. This can have long-term implications for their financial well-being, as they may not be able to leverage the power of compounding returns or protect their savings from inflation. To overcome the mistake of not investing, individuals should take steps to educate themselves about the basics of investing, seek guidance from financial advisors, and start with small, manageable investments to build their confidence. By taking a proactive approach to investing and making decisions based on their financial goals and risk tolerance, individuals can overcome the inaction bias and set themselves on a path towards reaching their long-term financial objectives. A lack of diversification leads investors to concentrate their investments in a limited number of stocks or asset classes, rather than spreading their portfolio across a variety of investments. This lack of diversification can leave investors vulnerable to higher levels of risk, as they may be overly exposed to the performance of a single company, industry, or asset. When investors fail to diversify, they increase the potential for significant losses if a particular investment or sector underperforms. Diversification helps to spread risk and reduce the impact of any one investment's poor performance. By investing in a mix of assets with different risk profiles, investors can potentially improve the risk-return trade-off and increase the likelihood of achieving their financial goals. Investors should consider building a well-balanced portfolio that includes a variety of asset classes, such as stocks, bonds, real estate, and alternative investments. By diversifying across industries, regions, and investment strategies, investors could reduce risk and enhance the overall stability and resilience of their investment portfolio. The investing mistake of not having goals refers to the failure of investors to establish clear financial objectives and a well-defined investment strategy. When investors do not have specific goals in mind, such as saving for retirement, buying a home, funding a child's education, or achieving financial independence, they may lack direction and focus in their investment decisions. Without clear goals, investors might take on too much risk or make impulsive trades, as they do not have a strategy to follow. To avoid this mistake, investors should take the time to assess their financial situation, determine their short-term and long-term objectives, and develop a clear investment plan that aligns with their goals and risk tolerance. By setting specific goals, investors can create a roadmap for their investment journey and make decisions that are in line with their financial aspirations. Avoid these 7 mistakes that many investors make, and it could help you achieve your biggest financial goals. Thanks for watching. Please like and subscribe, as I will be uploading a new money video every week. Until next time, keep earning, keep saving, and keep investing.